Chapter 13: Saving, Investment, and the Financial System. In this chapter, we seek answers to these questions. What are the main types of financial institutions in the U.S. economy, and what is their function? What are the three kinds of saving? What is the difference between saving and investment? How does the financial system coordinate saving and investment? How does government policies affect saving and investment and the interest rate? Financial institutions. Financial system may be defined as a group of institutions in the economy that help match the saving of one person with the investment of another. Financial institutions are institutions through which savers can directly provide funds to borrowers. And they include one, financial markets and financial intermediaries. Financial markets. Financial institutions through which savers can directly provide funds to borrowers. They include the bond markets. A bond is a certificate of indebtedness. Also, the stock market. A stock is a claim to partial ownership in a firm. The bond market. Bond is an IOU that specifies the principal, the amount borrowed, date of maturity, the time at which the loan will be repaid, rate of interest that the borrower will pay periodically until the loan matures. A bond buyer is a lender, can hold the bond until maturity, or he can sell the bond at an earlier date to someone else. Debt finance, sale of bonds to raise money. 4 characteristics of bonds. Term is the length of time until the bond matures. Short terms or long terms. Long-term bonds are riskier and they incur higher interest. Never matures are bonds to perpetuity. So they are long-term bonds to which interest rate charged is higher, and they are riskier, and there are bonds out there that never matures. Credit risk, the probability of borrower default. If there's a high probability of default, higher interest will be charged. Junk bonds, these are bonds issued by financially shaky corporations, and they pay very high interest rates. Tax treatment. This is the way the tax laws treat the interest rate earned on the bond. Interest on bonds, on most bonds, is taxable income. Municipal bonds issued by state and local governments are not taxed, and so the interest rate they offer is lower. Does it offer inflation protection? Nominal terms, specific number of dollars, indexed to a measure of inflation. When prices rise, the payments rise proportionately and these offer lower interest rates. A share of stock, which is ownership in a firm, and therefore is a claim to some of the profits that the firm makes. They carry greater risk but offer potentially high returns. Equity finance, this is the sale of stock to raise money. mostly through stock exchange. Trading stock shares, uh, stockholders. The business that issued the stock receives no money. This is trading in the secondary market. Price of shares on stock exchanges are determined by the supply of and demand for the stock in these companies. The demand for a stock reflects the people's perception of the corporation's future profitability. A stock index, an average of a group of stock prices. Dow Jones Industrial Average is a stock index. Standard and Poor's 500 is another index. Financial intermediaries. These are institutions through which savers can indirectly provide funds to borrowers. And they include banks and mutual funds. Banks. The primary role for banks, they take in deposits from savers, small interest rate they pay out. They use these deposits to make loans to borrowers. They charge a higher interest rate. Their profit is in the difference between what they pay and what they charge. Secondary role for banks. Banks facilitate purchase of goods and services. They provide checks and debit cards to access deposits. And these checks and debit cards are a medium of exchange and a store of value. Mutual funds. Mutual funds sell shares to the public and use the proceeds to buy portfolios of stocks and bonds. Advantages. They allow people with small amounts of money to diversify their holdings. That is less risk when diversification occurs. They give ordinary people access to the skills of professional money managers. Financial economists are skeptical. That it is hard to beat the market. Some important identities. Gross domestic product, GDP or Y. Total income is equal to total expenditure. Total income is Y is equal to C for consumption, I for investment, G for government, and NX for net exports. Assume closed economy where net exports is 0. So Y is equal to C plus I plus G. And rearranging the equation I is equal to Y minus C minus G. National savings, which is S, is also equal to Y minus C minus G. Total income in the economy that remains after paying for consumption and government purchases, by definition, is S for savings equals Y minus C minus G. So it follows that savings, or S, is equal to investment, or I, in a closed economy. Define T, taxes minus transfer payments. T is equal to taxes minus transfer payments. So savings, which is equal to Y minus C minus G, can be rewritten as S or savings equals to into bracket y minus t minus c, close the bracket, plus open bracket t minus g, close the bracket. So private saving equals y minus t minus c. Income that households have left after paying for taxes and consumption. Public savings is equal to T minus G, or tax minus government spending. And that is the tax revenue that the government has left after paying for its spending. National saving, S, is equal to private saving plus public saving. Budget surplus or deficit. A budget surplus is when T minus G is positive or greater than zero. That is the excess of tax revenue over government spending. That is public savings, which is T minus G. If it's a budget deficit, then T minus G is a negative or less than zero. That is the shortfall of tax revenue from government spending. And that is negative savings, which is, of course, T minus G. Active learning, applying the concepts. You have the following information. GDP is equal to 19 trillion. C is 13 trillion. G is 2.5 trillion. And budget deficit is 1.2 trillion. Number A, find public saving, net taxes, private saving, national saving, and investment. Number B, government cut taxes by 300 billion. Find the new budget deficit and answers to A if, number A, consumers save the entire tax cut, or number B, consumers save 1/3 and spend the other 2/3 of the tax cut. Answer: given y is equal to 19 trillion, C is 13 trillion, G is 2.5 trillion, budget deficit equals G minus T is 1.2 trillion. Public savings, which is T minus G, and that would be negative 1.2 trillion. Net taxes, which is taxes, is equal to 1.3 trillion. G minus T is equal to 1.2. G is equal to 2.5, so T equals 2.5 minus 1.2, which is equal to 1.3. Private saving, or 4.7 trillion. Y minus T minus C equals 19 minus 1.3 minus 13 equals 4.7. National saving equals investment. S equals I equals 3.5 trillion. S equals Y minus C minus G equals 19 minus 13 minus 2.5 equals 3.5. S equals private plus public saving, which is equal to 4.7 minus 1.2 equals 3.5. Answers: B, tax cut equals 0.3 trillion. Number A, consumers save the tax. Number B, consumers save 1/3 and spend 2/3 of the tax. Increase in consumption, 0. 1/3 of the 0.3 trillion is equal to 0.1 trillion. Net taxes is equal to 1.3 minus zero point 0.3 equals 1 trillion. It goes down by 0.3 trillion. Budget deficit, which is government minus tax, that would be 1.2 plus 0.3 equals 1.5 trillion. If there is an increase by the tax cut of 0.3 trillion. Public savings, which is T minus G, is equal to negative 1.5 trillion, and we have a budget deficit. Private saving is equal to Y minus T minus C. 5 trillion if it goes up by 0.3 trillion, or 4.8 trillion if it goes up by 0.2 trillion. National saving, or S, equals investment I, which equals Y minus C minus G. 3.5 trillion is unchanged. 3.3 trillion if it goes down by 0.2 trillion. The meaning of saving and investment. Private saving. Income remaining after households pay their taxes and pay for consumption. Examples of what households do with the saving. They buy corporate bonds or equities. They purchase a certificate of deposit at the bank. They buy shares of mutual funds. They let accumulate in saving or checking accounts. Investment. This is the purchase of new capital. Examples of investment. General Motors spent $250 million to build a new factory in Ohio. You buy $5,000 worth of computer equipment for your business. Your parents spend $300,000 to have a new house built. Investment is not the purchase of stocks and bonds. Loanable funds market. A supply-demand model of the financial system. It helps us understand how the financial system coordinates saving and investment, how government policies and other factors affect saving, investment, and interest rate. Assume only one financial market and that all savers deposit their savings in this market. All borrowers take out loans from this market. There is one interest rate, which is both the return on saving and the cost of borrowing. The supply of loanable funds. Saving is the source of the supply of loanable funds. Households with extra income can loan it out and earn interest. Public savings, if positive, adds to national saving and the supply of loanable funds. If negative, it reduces national savings and the supply of loanable funds. The slope of the supply curve, obviously positively sloped. Interest rate is measured on the vertical axis. Loanable funds is measured on the horizontal axis in billions. An increase in the interest rate makes savings more attractive, which increases the quantity of loanable funds supplied. Investment is the source of the demand for loanable funds. Firms borrow the funds they need to pay for new equipment, factories, and etc. Households borrow the funds they need to purchase new houses. The slope of the demand curve, with interest rate on the vertical axis and loanable funds on the horizontal axis, the demand curve is negatively sloped. A fall in the interest rate reduces the cost of borrowing, which increases the quantity of loanable funds demanded. As you can see, interest rate declining from 7% to 4% increases the demand for loanable funds from 50 billion to 80 billion. Equilibrium in the market for loanable funds. We bring the two curves together, the supply, the upsloping supply curve, and the downsloping demand curve. And the interest rate adjusts to equate supply and demand. The equilibrium quantity of loanable funds is equal to equilibrium investment, which is equal to equilibrium savings. Reaching equilibrium. If interest rate is less than equilibrium, quantity supplied will be less than quantity demanded, so there is a shortage of loanable funds. Encourage lenders to raise the interest rate, encourage saving that increases quantity supplied, discourage borrowing for investment, decreasing quantity demanded. If interest rate is greater than equilibrium, there will be a surplus of loanable funds and a decrease of interest. Interest rate will result. What do the experts say? Fiscal policy and the saving. Sustained tax and spending policies that boost consumption in ways that reduce saving rate are likely to lower long-run living standards. And 79% of economists agree. 21% are uncertain, 0 disagree. Saving incentives. Let's look at the demand and supply, the loanable funds market. Now, a tax incentive for saving increases the supply of loanable funds, which reduces the equilibrium interest rate. And this increases equilibrium quantity of loanable funds available. So, greater supply and investment. Investment incentives. An investment tax credit is an example of an investment incentive, and this increases the demand for loanable funds, shifting the demand to the right. This raises interest rate, which raises the equilibrium interest rate and increases the equilibrium quantity of loanable funds, and therefore greater supply and greater saving and investment. Government budget deficits and surpluses. Let's look at budget deficit, or G is greater than T, excess of government spending over taxes. Government debt, which is accumulation of past government borrowing. Budget surplus, where tax is greater than government. Excess of tax revenue over government spending. They repay some of the government debt. And the other option is balanced budget, where government spending is exactly equal to tax collection. Active learning, budget deficits and surpluses. Assume the government starts with a balanced budget and then because of an increase in government spending and or decrease in taxes, starts running a budget deficit. Use the loanable funds model to analyze the effects of a government budget deficit. Number 8, draw the diagram showing the changes in equilibrium. What happens to the equilibrium values of the interest rate and investment? Analyze the effects of a budget surplus. So let's see loanable funds market with equilibrium at 5% interest and 60 billion loanable funds. So a budget deficit reduces national savings and supply of loanable funds. Supply shifts to the left. This will increase the equilibrium interest rate from 5 to 6 and decrease the equilibrium quantity of loanable funds and investment from 60 to 50. Number B, a budget surplus increases the supply of loanable funds, reduces the interest rate, and stimulates investment. Policy 3 lessons. Budget deficit reduces national savings, decreases the supply of loanable funds, interest rate rises, and investment falls. Budget surplus increases national saving, increase the supply of loanable funds, reduce the interest rate, and stimulates investment. Case study: the history of US government debt. The government finances deficits by borrowing, that is, selling government bonds. Persistent deficits lead to a rising government debt. The debt to GDP ratio is a useful measure of the government's indebtedness relative to its ability to raise tax revenue. Historically, the debt to GDP ratio usually rises during wartime and falls during peacetime until the early 1980s. So we can see government debt as a percent of GDP through the years since 1791, with the highest ratio during World War II. After World War II, it came down, and then we saw a rise in 1991, and then there is a very large increase during the financial crisis of 0809. Financial crisis of 0809. A financial crisis led to a deep recession in the US and around the world. A few unemployment rate selected countries you can see over the years. And all these developed economies had higher unemployment during the Great Recession, starting with 0809. Elements of financial crisis. There was a large decline in some asset prices. Housing prices fell 30% between '08 and '09. There was widespread insolvencies at financial institutions. Banks and other institutions failed when many homeowners stopped paying their mortgages. There was a decline in confidence in financial institutions. Customers with uninsured deposits began pulling their funds out of financial institutions. 4, there was credit crunch. Borrowers unable to get loans because troubled lenders not confident in borrowers' credit worthiness. Number 5, economic downturn. Failing financial institutions and a fall in investment caused GDP to fall and unemployment to rise. Number six, vicious cycle. The downturn reduced profits and asset values, which worsened the crisis. Think, pair, share. You are watching a presidential debate when a candidate is questioned about his position on economic growth. The presidential candidate steps forward and says, "We need to get this country growing again. We need to use tax incentives to stimulate saving and investment, and we need to get the budget deficit down so that the government stops absorbing our nation's savings." If G remains unchanged, what inconsistency is implied by the presidential candidate's statement? If the presidential candidate truly wishes to decrease taxes and decrease the budget deficit, what has the candidate implied about his plans for G? Think about it. Chapter in a nutshell. The US financial system, many types of financial institutions, the bond market, the stock market, banks, and mutual funds, they direct the resources of households that want to save into the hands of households and firms that want to borrow. National income accounting identities reveal some important relationships among macroeconomic variables. For a closed economy, national saving must equal investment. Financial institutions is matching one person's saving with another person's investment. The interest rate is determined by the supply and demand for loanable funds. The supply of loanable funds from households that want to save, the demand for loanable funds from households and firms that want to borrow for investment. National savings is equal to private savings plus public saving. A government budget deficit is negative public saving, reduces national saving and the supply of loanable funds available to finance investment. Government budget deficit crowds out investment, reduces the growth of productivity and GDP.